All right, so the word of the day is head scratcher, although that might be two words, okay? I think it's the best way really to describe what's been happening with this market these recent days. And it all starts really with inflation, right? Because it's all about inflation, the impact on the economy, and obviously on policy. Now, yesterday we got what appeared to be a benign inflation report, at least compared to estimates in these recent trends. But upon further review, there were a lot of asterisks. And sure, there were big declines in reopening components as the spread of the Delta variant was curbed. But, you know, when you think about it, isn't that all supposed to be transitory anyway? I'm going to bring in Bianco Research President Jim Bianco. And Jim, you've been in a non-transitory camp for a long time. And I look at some of these surveys there, it seems like the street is increasingly saying, no, this is all transitory. How did yesterday inform where we should be thinking now?
Yeah, I understand that, you know, the street vernacular is team transitory had a win yesterday because the overall CPI report came in below average. But if you split it out into two broad categories, the reopening categories, the airlines, the hotels, the used cars, the rental cars, and the like, those categories declined. But if you look at the non-reopening categories, this is what you would refer to as the persistent categories of housing and shelter and new cars and the like. They actually made new multi-year highs. So the persistent categories are slowly continuing to move higher, although these very volatile type of reopening categories, you know, restaurant prices and airline tickets that are moving around all over the place, they declined. And everybody just immediately said, that's it, transitory one. But underneath it, it looks like the non-transitory items are showing some strength, which is concerning because that means that inflation might be something more than just a transitory item that's going to go away. It's going to stick around for a little bit longer.
No doubt about that. I mean, it was pretty clear in that data. But can you explain something to me? I've got a chart. It's the historic relationship between a 10-year bond and inflation. They usually go hand in hand, and all of a sudden, there's a gap like the size of the Atlantic Ocean. Inflation obviously well above 5%. The 10-year bond meandering down to about 1.3. Why is that? How do you explain that?
Two things. First of all, there is the belief that the street believes that that 5% inflation rate is transitory, to use the word of the interview, and that it will come down over time and that that gap will close by that high inflation rate falling. I think that's somewhat true, but I don't think it's going to come down as much as everybody thinks. Also, you have the Fed buying $120 billion of bonds a month. So you've got a gigantic buyer of bonds that are holding those interest rates low, and that's by design. They want to keep interest rates low. They want to chase everybody out of the bond market. They want them to take more risk, buy corporate bonds or buy stocks in order to boost those markets. That's always been the design of the product of the program. So I think those two factors, that it will come down a little bit, the inflation rate, but I don't think as much as everybody thinks. And Fed buying is why you've got that enormous gap.
So the bottom line, though, we should expect some sort of reversion to the mean. So that means if inflation only comes down slightly, the 10-year yield's got to go up a lot more.
Yeah, that's right. And when the 10-year yield does go up, there could be a rethink on Wall Street that transitory inflation might become persistent inflation. Persistent means the Fed's got to do something. That's code word for they got to stop buying bonds or maybe consider sooner raising rates. And that could unsettle things like stocks. But that's not today's story. That might be a story for later this year or early next year.
Well, let's talk about a tweet. I only got 30 seconds, but I'm throwing an audible because you put a tweet out just moments before the show that caught my attention. There's some sort of talk about maybe the Fed changing course, tearing up the script, and instead of tapering, hiking rates first and then tapering. How would that work?
Yeah, so the Fed wants to remove accommodation. So some people have argued the idea is they want them to stop buying bonds, but instead, maybe what they should be doing is continuing to buy bonds and raise rates first, because that's less impactful on the economy than their bond buying program. I know not everybody agrees with that, but there is a debate going on as to how important is the Fed's bond buying. I think it's really important, and that's why I put that tweet out and I, kind of solicit comments, because it does bring up an idea that could it be that that's more important than raising rates? The Fed doesn't think that, but more and more people are starting to consider it.
Yeah, certainly it's a very intriguing proposition. Of course, somewhere Jay Powell is snickering, saying, I'm not going to do either one. Jim, thanks a lot. Always appreciate it. All right, folks.